Thank you for tuning into the All Funds Network podcast. My name is Mike Schroeder. Today I'm joined by my colleague Steinke, my co-host, and we're also joined by Tony Davidow. Tony Davidow is a senior alternatives investment strategist at Franklin Templeton. He's a former executive at Charles Schwab, Morgan Stanley, Guggenheim, and he's also the host of the Alternative Allocations podcast. Make sure to check out his podcast as well. He's also the author of Private Markets, Practical Guide for Advisors looking to integrate private equity, credit, real estate assets into modern portfolios. So we got a lot to talk about here. We're going to be diving into the democratization of alternative investments, kind of the role of alternatives within a portfolio, and a lot more. So, Tony, thanks a lot for joining us.
Thanks for having me, Mike. And when I hear that intro, I think, God, I'm an old guy, and apparently I can't hold a job.
You've done well. We're excited to have you, Tony.
Thank you.
We'll have to talk about.
Yeah, maybe we just kick it off. Kind of tell us about your role at Franklin Templeton. Kind of what are you working on day to day?
Yeah, and maybe just a hair about my background. I've obviously been doing this a long time.
Please.
And began my career working for a family office. And after working for a lot of big firms, I really wanted to set up my own consulting business, and gravitated pretty quickly to two types of assignments that I was typically getting, either working directly with family offices who were trying to understand their menus and understand how to better utilize alternative investments. And I was also engaged at the same time to develop alternative education training programs. I helped build a program for iCapital called Edge. I did some work for the Investment and Wealth Institute on their private markets program. And then ultimately, Franklin Templeton asked me to build a alternative education program geared to the wealth management channel. And I think one of the things they recognize relatively early into the assignment is it's great to have all this educational content, but putting things on a shelf isn't enough, right? We need to constantly engage our audience and all of that. So they literally created a role for me so I could help engage clients along their journey, wherever they are on that journey. So whether it's basic foundational materials, we have training materials, I have white papers, I have blogs. As you mentioned, I have a podcast series, and I've written a book. So we try to provide content all along that journey to help advisors make better informed decisions along the way. And what keeps me busy? Well, the world keeps on changing, and it's an exciting time for all of us as we have more and better products coming to the market. But there's a need to help advisors think about how to best use these and to fulfill clients' dreams and aspirations.
Yeah.
Very cool. We have a lot of time back there. I think maybe just as a starting point, maybe talking about that change over time and how it's kind of fed into where we're at today from an alternatives perspective with advisors. Maybe what the original thought was when you kind of started your career, spanning to what's happened over time and what the portfolio allocation looks like relative to alternatives, what that means for advisors, and how the maybe perception has changed a bit. I know there's a lot there, but maybe just kind of, if you want to kind of give us a little bit of a preamble, if you will.
There's a lot to unpack there, but I think I'll try to weave it together. When I started my career, I started my career working for a family office, which is not the natural place that people start. But again, when I was starting with the family office, we made a lot of investments in private equity and private real estate and really didn't think anything different about it because it's the way that we were investing capital from one generation to the next. So it was kind of part of the normal playbook for family offices. Along the career path, I spent a fair amount of time at Morgan Stanley. And at Morgan Stanley, one of my initial roles was building our institutional consulting business. So I worked directly with a lot of big endowments, foundation, pension plans. Not surprisingly there, they also used an awful lot of alternatives to fulfill kind of their needs over time. And then later moved over, ran a small little business called Greystone, which at the time was a multifamily office boutique that we bought with a deep expertise in alternatives. We ended up integrating that into our Morgan Stanley private wealth business. So I had the great opportunity to work with a lot of our banking clients. And those were often founders who, made a lot of their money with a private enterprise that eventually they either took public or they sold to an acquirer along the way. So I saw firsthand the value of those private enterprises and the freedom it affords you to manage a business in a different way. And my last stint at Morgan, I think, starts to tie some of this together, Skyler, which is at the end of my tenure, I was asked to run sales and training for all three segments, the retail, the private wealth, and the institutional segment. And the reality was, back then, the wealth channel was very limited in what they had access to. So we didn't have a lot of alternatives 20 years ago.
Yeah.
We didn't have access to it, even though you and I might have recognized the need that wouldn't it be great if we could bring our clients world-class private equity managers. We just didn't have a way of doing it. So I'd say over the last decade in particular, we've seen incredible growth in the types of strategies that we're bringing to the marketplace, strategies that historically were only available to institutions and family offices. And in particular, in the private market space, private equity, private credit, private real estate really weren't available. And now as we're starting to get more products that come to the market, which are really more conducive to the way that individual investors allocate capital, we're excited about the opportunities, but we realize there's that gap that we need to fill, which is how do we think about these strategies? What's the difference between public and private? And then ultimately, what do we expect to solve for when we add them to client portfolios? So we've come a long way. But again, all these great opportunities provide some challenges as, we've got different tools that we need to bring into our toolbox.
Yeah. Yeah. It's it's actually an interesting thought process as you think about what happened in the past. My background also was in public and private markets, setting up mutual funds and ETFs, and then getting into the private space. And I think to your point, a lot of the public and private aspects have blurred a bit, right? There are hybrid products in the middle too. So from an RA perspective, it'd be interval funds that have some alternative slant to them or something like that. So I'm sure you've seen a lot of that, and obviously then training folks on this phenomenon, how they need to think about the markets. I'd love to kind of hear your thoughts on that too.
Yeah, and if I could, I'd love to jump in on that because I think that's part of it, right? So the first generation of products, not only were they not generally available, partly because there were drawdown structures only available to qualified purchasers, but they really weren't conducive to the way that you would scale something across your practice, right? They had very high minimums. They had limited, if any, liquidity provisions at all. So it was very, very difficult to utilize across your book of business. And what we think is very exciting today, and to pick up on something that Mike said earlier, the whole democratization, in our view, is driven by the fact that we have products that now can be used in scale. So I'm going to broadly use the nomenclature evergreen or perpetual funds, which are all of these strategies that are forever on your shelf. And then Skyler, you mentioned underneath that, I would say those are interval, tender offer, private BDCs, and non-traded REITs. So all of those hybrid type structures actually provide the benefits of giving the manager the ability to manage for the long run, which is really important because we want to capture that illiquidity premium, but also the flexibility to have a credit investor or below, lower minimums, more flexible features to deal with liquidity and things like that. So to me, that has helped democratize because it's made them much more broadly available than ever before.
When it comes to like RIAs, how do they normally get introduced to alternative investments? Because as you alluded to, I mean, there's so many different products out there. There's so many different opportunities, different investment types. I mean, where does one even start?
Yeah, I think it's a challenge for the industry overall. And I think that if we're honest, sometimes we make things a little bit more complicated than they should be. We could probably spend a whole podcast talking about some of the naming conventions that we use, like alternative investments. Well, alternative to what, right? It feels a little scarier than it should be. And then, we'll often use terminology that makes it a little bit more confusing. So you're trying to figure out, well, what is this ultimately solving for? Why would I add it to my client portfolio? So I think in the last couple of years in particular, there's been kind of this collaborative sort of exercise across the industry where firms like Franklin Templeton and many of the big asset managers, organizations like Kaya or the Investment and Wealth Institute have recognized that we need to figure out how to make it easier. We need to give you kind of the tools and the understanding so you understand what ultimately the investment solves for, how to add them into client portfolios, as we're just talking about, how to distinguish the structures and what's the right structure for each one of your client segments. So I think there's been recently a lot more collaboration and coordination to make this easier for all of you to get access to. There's a lot of free information. I know for us, and again, as part of my journey, when you asked about like what brought me here, was we recognized having training programs on the shelf wasn't enough because you'd have to figure out to come to us that they even exist, right? So for us, we want to make sure that we have outward reaching things like a podcast that, like your podcast, reaches thousands and thousands of people in an easy to consume sort of format so you can get comfortable with the language, the terminology, and ultimately what the strategies do. We have white papers for teams who maybe want to go a little deeper. So maybe the CIO and the head of research wants to get into the weeds. We have all the research that shows what the historical performance of the asset classes have been. And then we have blogs, which are somewhere in between. But I think at the end of the day, what we have recognized, and I think a lot of other firms in the industry have, we need to meet advisors wherever they are in the journey. And whether you're an RIA or you're sitting at a wirehouse, everyone has different levels of experience with these tools, and everyone needs help getting a little farther along with the process, in large part because it's changing all the time. The complexity and the amount of strategies on your menu are constantly expanding. A good thing, but also a challenge.
To that point, kind of how are managers finding you, and how are you guys adding somebody to a platform? Because you got to imagine there's probably, I don't know, thousands of different funds out there. I mean, even just think about like real estate, like there's got to be thousands of different funds out there. So like, how do you, and also if you're running a fund that's, $100 billion, it's kind of maybe potentially like lower returns, things like that. So, I mean, how do you think about, how do managers find you, and how do you think about adding them to the platform?
Yeah, well, so we're not adding managers to the platform in the way that, a Schwab or Fidelity would, or a Morgan Stanley. We're obviously an asset manager. So Franklin Templeton has really had a very interesting approach that goes back quite some time. Our CEO, Jenny Johnson, recognized the need to bring private markets to the wealth channel. And she's made a number of strategic acquisitions. So we bought Clarion Partners, which is a world-class real estate manager. She bought Benefit Street Partner, which was a private credit manager, and Lexington, which is a secondary manager, which is one of our favorite areas to focus on. We think a great way of playing the PE marketplace is through the secondary market. And she's made a number of other recent acquisitions along the way to kind of build out that menu of capabilities. And what she did is she recognized we need to acquire world-class managers, and we need to give them the freedom to do what they do best, which is invest for the long run, but marry them to the distribution organization that Franklin Templeton brings. So our Franklin Templeton representatives who may be calling on you and other firms have on their menu of all the strategies available a whole array of traditional and alternative investments, and their job is to determine which is the right strategy for what you're trying to solve for with your client. So I think we're in a very enviable position of having $260 billion in alternative assets under management, and that is growing very, very rapidly. It's the biggest part of our growth engine. And other firms figure out different ways to do it. Some asset managers choose to partner with traditional alternative managers. But I think our approach has really given us kind of a great vantage point into what's happening in the institutional world and bringing those capabilities to the wealth channel.
Yeah. What are your thoughts, Tony? You're talking a lot about, education, and you've been heavily involved in building out a program for that, and meeting advisors where they're at. I mean, what are some common misconceptions? And we hear a lot about, have a lot of different people on our podcast as well. It's the typical 60-40 portfolio it's dead. It's no longer viable anymore. All these different things that come out. But from talking to advisors that you do, I'm sure quite a bit, what are the common things that maybe that misconstrued or a bit of mythbusters, if you will, that are out in the space?
Yeah, I think the unknown often leads to myths and misconceptions, and there's a lot of misconceptions when it comes to the private markets. I think there's a couple things that I like to address, head on. One is private markets have historically, the reason we're having this discussion is the appeal of private markets is historically they've delivered this illiquidity premium. They've provided excess return over the long run. And sometimes the misconceptions are, well, geez, they're just funny accounting going on. How is that really happening? I think the reality is we have to think about all those misconceptions, peel back the onion one layer at a time. The reality, and you guys know it because you're in the market every day, the public markets are shrinking pretty dramatically, almost half the size over the last 2 decades. So we had 8,000 companies 2 decades ago. We now have 4,200, 4,300 companies, which, by the way, I could go off on a tangent. Why do we have the Wilshire 5,000 if we only have 4,200 companies? That's a whole other issue.
Right.
The flip side of it is we now have something of the magnitude of about 20,000 companies with 100 million more in revenue in the US alone. That's 100,000 globally, by the way. So what we find is the public market universe is shrinking and the private market universe is expanding. Kind of a related corollary sort of statistic on that is the fact that a lot of those companies are staying private longer. Some will never go public. So in the old days, when I started in the business, the reality is if you wanted to monetize your business, you had to either go IPO or hope that somebody came along and acquired your company, what we'll refer to as exits. The reality is a lot of those companies are going to stay private longer. Some will never go public. And the example I often give is SpaceX, right? Elon Musk, gets enough scrutiny with Tesla and his other public enterprises. Do you think that Elon Musk wants to bring SpaceX public? My guess is it will always remain a private company
Right.
because it gives him the freedom to do what he needs to do, which is invest for the long run without the scrutiny of somebody looking over his shoulders on a quarter-over-quarter basis. So to me, we need to kind of change the discussion to how much should we have public and private? It's not one versus the other. But I would just say very simply, the reason we have that illiquidity premium is it's the inefficient assets that often provide the best opportunities. That's the way that David Swenson thought about it many, many years ago. It's the way that we think about it. The best opportunities to generate excess return are in the inefficient sides of the market, not the efficient side, which is shrinking, and all that information is readily known. So one is just understanding what the data tells us. There are a lot of misconceptions around, whether private equity is good or bad for the economy. I'm not going to get into that, but I think again, there's often this portrayal of private equity companies being similar to Barbarians at the Gate. Barbarians at the Gate was a great book and a great movie because it was a sensationalized sort of story and it showed the excesses of LBOs. Well, the reality is most buyouts today are not LBOs, and most are not leveraged to the gills the way that R.J. Reynolds was in that transaction, which became a great story and all of that. So there's this portrayal of a lot of those people just loading companies with debt, and then all of a sudden those companies are doomed for failure, and then everyone walks off into the sunset, and the only people who win are the people who did the transaction. Today, that's not the case. Today, you're having private equity companies who are making investments and they're helping to unlock value, which is how they actually achieve that long-term excess return. They're unlocking value in those young enterprises and allowing them to grow and be successful before they go to the public markets, or they may choose again to just remain a private enterprise because now there's abundance of capital available to them. So I think there's a lot of those myths and misconceptions. And again, it's just peeling back the onion and just having a rational discussion about what the underlying investments are. My hope in the next couple of years is we start to have discussions as what's our allocation to public and private rather than one is better than the other. They're just different. It's almost, I'm listening to somebody today who was making the comparison of the old small cap premium, Skyler, that you and I grew up with when we started in this industry. Everyone talked about that small cap premium, which has essentially gone away. And part of the reason it's gone away is the small cap premium came from a lot of those companies who were private, went public, were small cap, and then they grew exponentially because they were still young and could reap the benefits of being nimble. Those companies are staying private today. So that small cap premiums, in fact, being captured in the private enterprises.
Yeah, for sure. There's actually a couple of really interesting points you brought up there. I think maybe the most interesting one is kind of just the companies staying private longer. Like you mentioned, like Elon Musk probably doesn't need another headache of dealing with SpaceX being public. Like how do you see that kind of evolution evolving over time? Are people just going to kind of stay in the private markets and just stay quarterly liquidations?
I think so. I think the reality is there's a lot of freedom that you have being an independent company, making your own decisions, truly thinking long run. I asked our CEO, Jenny Johnson, on my podcast about the difference between public and private. And I thought I would get, one of these safe sort of answers. And she was very honest about it. The reality is if you're a private enterprise, you're not thinking quarter to quarter. You're thinking year over year. You're thinking 5 years down the road, 10 years down the road. There's a lot of freedom that you have. Where if you're a public enterprise, even though you might have a 5-year plan or a 10-year plan, you're constantly being scrutinized on what you do on a quarter over quarter basis. So I think for young, dynamic companies, yes, they're going to stay private longer. Maybe they'll never go public. The other sort of phenomena that we see in the market today is there is an abundance of capital available to them. So they don't have to wait for an exit to monetize their opportunity, which, in my book, one of the examples I gave, because I think one of the things we need to do a better job doing is make this feel a little bit more familiar to individual investors. And I'll often hear things like, well, if I look at my statement, I know Apple, Microsoft, Google, and Meta, right? Those are names that are household names. I'm really comfortable with them. And I'll often turn back and say, but you do realize they were all private enterprises before they went public. Well, they went public because in the old days, that was the only path for them to monetize their business, not only for them to reap the benefits, but to pay their employees. In the book, I actually talk about the Google example. So when I was at Morgan, I had the opportunity to work with a number of Google executives. And I think Google is kind of a great case story when you think about it, because you have these two brilliant young Stanford PhD students. They were 25 years old at the time, and they had this idea. Their original company, by the way, was called PageRank. It wasn't Google. And they had this great idea, but they didn't quite know where it would go. And they didn't really know if it was a business or not. The interesting thing is Jeff Bezos of Amazon was one of the early investors in Google, as it was at the time, and he recognized the value. But there was a long path to going to the public market. As they started to refine their business and really understand what they wanted to be when they grew up, they also recognized that they were two young kids with a lot of great ideas, but not necessarily the experience of running a public company. So they brought in Eric Schmidt. Eric Schmidt was formerly the CEO of Novell. He came in and helped prepare that company to go public. And what was interesting is, he did a lot of putting in the structure in place and the accounting and the reporting and all of that. So when Google went public, they reaped the benefits, and then they were able to make a number of really terrific acquisitions to build what we refer to today as Alphabet, this mammoth enterprise that we can't even imagine not existing, right? It's a multi-trillion-dollar company, but they started as a small idea, not quite sure of the path that they would go on. And that's the path that a lot of these private companies go on. So the more that I think we can personalize it and make it feel a little bit more familiar to individual investors, the better. But, Mike, to your point, I think a lot of those companies will choose to stay private longer or maybe never go to the public market. By the way, an interesting phenomena is we are seeing public companies going private. Right?
Yeah.
Mm-hmm. Maybe a public company that's got a little bit too big and they're not scaled appropriately. They are now going private. Often that's a greater opportunity to reorganize them, restructure some of the business, maybe sell off some unprofitable parts. They may or may not emerge again in the public market. So again, it's just a different structure, and we need to be a little bit more mindful of the fact that the private markets are growing because it has a lot more freedom, and the public markets are shrinking because there's a lot of public scrutiny that goes on to managing a company in the public space.
Yeah.
Yeah.
Very, very good points there, Tony. Going back to what you said on the liquidity premium, I think that's an interesting topic too, because I guess in my space, traditionally in the past, you talk to advisors and think about public versus private, liquid versus illiquid. It's hard to get into an alternative investment versus just a public investment. So I can find a public investment equivalent to alternatives easier that may have a similar return outcome. What are your thoughts on when someone says that?
Yeah, so again, I'm really Switzerland. I'm not talking about any specific fund or product. I'm really just looking at research in the industry, and I spend a lot of time, just because of my background, I spend a lot of time looking at how have institutions and how have family offices allocated capital. And if I look at the data, and again, I'm looking at real data. So we spend money to get real universe data, looking at private equity companies. Private equity has historically delivered a 300 to 500 basis point illiquidity premium, the excess return that you get for tying up capital for an extended period of time. And again, that's a comfort level. So I often argue that the intellectual argument is an easy one. If I showed you the data on a piece of paper, you would say, of course I want that. If I can invest in private equity, get higher returns and lower risk, I'm going to take that all day long. I would too. But the reality is, and again, my job is to provide kind of the balance of all of this. The reality is you need to be comfortable with locking up capital for an extended period of time. You're not going to get that illiquidity premium if you buy it today and sell it tomorrow. So I think, to me, the way that I think about it is, as you sit down with your clients, and I actually wrote a paper called the Cost of Being Too Liquid. It's kind of a shorter version. You can certainly read my book, but the shorter papers are sometimes more effective. And I tried to tackle head on what I perceive as the biggest challenge for advisors and investors, which is getting comfortable with giving up control of an investment to capture that illiquidity premium, right? It feels uncomfortable for us. But what if we turn it on its head and said, well, if I want to capture that excess return, I've got to be comfortable locking up the capital. But rather than having that discussion after I've invested in the fund, we actually should have that discussion in the beginning. So going through the discovery process, what if you built in one simple question to the questions you're asking your clients about their goals, dreams, and aspirations, which is, how much of your capital are you comfortable committing for the long run? I think for a lot of high net worth investors, that's a 10, 15% allocation. That's great. Let's carve that out and let's call that an illiquidity bucket. By the way, that's the way that Harvard and Yale think about it. They have a 40, 50% illiquidity bucket, but that's the way that they think about it. So if we take that 10% allocation, we're calling that our long-term capital. I'm actually treating that differently, and I'm actually communicating to the client differently about it. That's my long-term patient capital allocation. When there's a bump in the road and when your clients feel uncomfortable, and we know they will because we know there'll be more volatility, more bumps in the road, let's just say, okay, that's great. I feel your pain, but let's think about de-risking your portfolio with your traditional investments. Maybe we'll lighten up our equity exposure. Maybe we'll add a little gold to your portfolio, but we'll keep that 5%, 10%, whatever that illiquidity bucket as my constant patient capital. Well, by doing that, what are we teaching clients? We're actually teaching them to be long-term investors. So to me, that's a very good thing. And I think both of you would recognize the biggest challenge is when there's risk to the market, the temptation, this behavioral element that we all fight, the three of us, and certainly all of your clients, is the temptation to head for the exits at the wrong time for the wrong reasons. So in fact, having that patient capital, we protect our clients from making the wrong decision. So I think that's one way of kind of tackling what is perceived as a negative and really just treating it as a feature.
Makes sense. Kind of you don't see it, you don't know about it, just you don't know what's going down. It's just there. The protecting you from yourself kind of thing, if you will.
We all study behavioral finance. We know all of these emotional impulses that we respond to. It's what do we do about it, right? And this is one way that we just treat it differently. We kind of bucket it. We put it aside. We treat it differently. We condition the investor from the very beginning that this is our long-term capital. By the way, if we started with a 5% illiquidity bucket and we held that investment to 7 to 10 years and we got that illiquidity premium, that excess return over the long run, it'd be a lot easier to have the next discussion about increasing the allocation or introducing another private market type investment. So I think there's a lot of benefits of just kind of treating it a little bit differently, recognizing illiquidity is just a feature, not necessarily good or bad, and really kind of conditioning our client to think of that pool of capital differently.
On this topic of like education, is that kind of one of your biggest challenges when it comes to, the advisor's clients, really like helping them get over kind of their mental biases and hurdles?
I think that's clearly one of them. I think if we're honest and look, the three of us do this every day. And, if the three of us went and had a cup of coffee, we likely would fall into the trap of talking J-curve, drawdown, all the terminology and jargon that is part of our industry. I think one of the biggest challenges for us, and we need to be mindful of this, is the conversation that we have with clients so we don't confuse them, right? We have a lot of confusing terminology in this space. I think more than just the general sort of stock and bond sort of discussion you may have. It's the structures are more complicated. There's a lot less, jargon that we easily fall into, drawdown, capital calls, all of these things that clients really don't understand. So to me, I think the biggest challenge for advisors and the biggest challenge when I'm speaking to groups of clients is how do we take this complex discussion, break it down into terms that they understand? So remove the jargon, talk in terms that they understand. How do we tell stories and look, we're all storytellers, right? I mean, part of the podcast is you're telling a story. You're bringing somebody else into your conversation, but you're telling a story because it's easier to consume a short, bite-sized story as opposed to reading a big book like the one behind me. So to me, the easier we can make the discussions, the more relatable we can make it to clients so they actually know what they're investing, they know why they're investing, and they know ultimately what they should expect from that investment, the better it is. And the more that we can remove a lot of that jargon, I think then we're having a discussion with them, as opposed to the temptation is we fall into our jargon and we're having a discussion up here and the clients are down here. And there's this big communication gap that we haven't quite figured out how to fill.
Yeah, well said. I think sometimes the jargon in our industry, it was put forth by design in a lot of ways, almost to kind of separate folks to understand kind of the nuances. Maybe not, because like you say, you strip away the layers.
I think it's sometimes I agree with you. It's sometimes self-inflicted. We do it to ourselves.
Right. We do. Absolutely. And going back to what you talked about, emotional intelligence, I think it's key and important too. I mean, thinking about I think you've written about goal-based investing as well, Tony. I mean, how should the mindset of an advisor, how they shape their mindset when they're speaking to their clients and talking about these topics? I think it's probably very important.
I really do think it's important. I think, again, I'm a little bit of a propeller head, but I'm very mindful of how clients consume information. I have a wife and two daughters who are teachers, and I sometimes use them as a litmus test. Can I explain something to them in terms that they will understand? It forces me to kind of bring it down a little bit so it's a little bit easier for them to understand. And when I think about investments, I do the same thing. I think about, we can get super complicated. I can show you mean variance optimizations and efficient frontier analysis and all of this stuff, and we're probably going to lose the clients. But if we can simplify our discussions a little bit more on ultimately what are the roles that individual investments play, and I think there are four primary goals that we're always solving for. We're either looking for growth, income, defense, or inflation hedging in our portfolio. All investments fall into one or more. Things like real estate may actually hit all four of those. But if we define it in terms the clients understand, and I've kind of used doing client events as a litmus test where I can get into the geeky sort of terminology and I can see clients glossing over, or I can start to simplify it. And I use this very simple puzzle piece analogy to kind of tell the story. If I'm focused on my growth bucket, well, where am I getting growth? Well, I'm primarily getting it from my equity allocation. But rather than just think about traditional equity, maybe I should think about private equity, or maybe I should think about private real estate, which would give me growth in my portfolio. If I'm thinking about income, I think of my traditional fixed income options, but why not then think about private credit, private real estate debt, right? Because I can pick up more income that way. If I think about defense, I probably think about cash and gold, but why not think about real estate? By the way, real estate equity and real estate debt have negative correlation to both stocks and bonds, right? So those are my defensive assets. And if you think about hedging the impact of inflation, I can think of my real assets, and that's infrastructure, that's real estate, and that's natural resources. So if I simplify it that way and I focus on what are the roles that they play, I think it's an easier discussion for clients, right? Because then all of a sudden, I hopefully move them off the fixation on, did you outperform the market? By the way, if we look at all of those investments, most of those investments are not designed to outperform the market. Most of those investments are really designed to provide discrete sort of goals in your client portfolios. My private equity allocation, I'm expecting to get growth. I'm going to measure them. Did I get incremental growth relative to my traditional equity allocation? That's my yardstick to say whether it's working or not. I'm adding my private credit and my private real estate because I want to get incremental income above and beyond what I can get from my fixed income. And if I'm thinking about defense and I know I'm going to have shock to the market, can I get some shock absorbers in my portfolio? I might think about real estate and real estate debt. So I'm changing the way that I have discussions with them. And by the way, this works for all investments. If we can define where they fit kind of across those four goals, I think it's a healthier discussion to have with clients. I suspect you've done a really good job with your clients in training them about your value over the long run. But I do hear from a lot of advisors this thing is, well, I'm doing just fine. You made the comment at the beginning about the 60-40 portfolio. In the run-up, when we went through the longest bull market in history, people were saying, I don't even need international. I'm fine with my S&P and my bond. Simple is better. That's not the case going forward. I don't think that there's any chance that is the best solution on a going forward basis. I think we went through a little bit of an anomaly, went through a period of zero interest rates. The market shrugged off a lot of bad noise that we're now ultimately paying the price for. So I'd argue you need a more robust and reliable toolbox. And that's the role that I think about for alternatives. How do we fill in the gaps that exist within our traditional portfolio? We're not replacing stocks and bonds. We're actually extending the tools to have better, more finite tools, more precise tools to solve for today's market environment.
Yeah, that's really cool. I like the way you think about all that, especially like the four kind of goals, in terms of growth, defense. I think inflation hedge, there's one more.
Yeah.
But yeah, I like that a lot.
Yeah, I think inflation hedging is something we haven't really had to talk about a lot, except for, in the last couple of years where inflation spiked.
Yeah.
But the reality is, I think of real estate is actually a better inflation hedge. I don't know. I'm being a little sarcastic here. I don't know if tips work, right? So tips are more driven by supply and demand, right? We think something's going to happen, therefore we buy a lot of them, and we're actually moving tips more based on supply and demand rather than the fundamentals. But I know if I look at real estate or infrastructure, because of the way that they're structured, because of the way that the contracts are actually built, there's actually typically an inflation kicker in there. So if inflation goes up, they're automatically adjusting over time. I know those are effective ways of hedging the impact of inflation. So to me, I'm not disregarding the toolbox that you typically have at your disposal. I'm just saying if we expand it, we'll have better outcomes for our clients. And if we simplify the role that they play, we know how and where to source capital. The other question I get a lot from advisors is, I love private equity. Well, where do I source it from? Well, since I'm really sourcing it, assuming my asset allocation over the long run hasn't changed, I'm going to source it from my equity bucket, my growth bucket, right? Because that's an equity surrogate. If I had a different view of the world and I wanted to be more aggressive, maybe I would add it and I'd take it from my fixed income because I'd want to get more growth in my portfolio today. But assuming my asset allocation hasn't changed, I'm typically sourcing it from a like resource.
Yeah, makes a lot of sense. I guess on the fixed income side, last couple of years have been wild in terms of rates. What when it comes to your clients' investments, are people still investing in treasuries? Like, obviously, we kind of talked about here, like 60-40 is not really happening anymore. Are people investing in treasuries, or is it kind of all just private credit at this point?
I think people are investing in traditional fixed income, but I think the reality is, especially, when we were going to a zero interest rate environment, we went through a period of, pretty substantial rate changes, high inflation. We've gone through some pretty big shocks over the last couple of years, and let alone where we are today with a lot of uncertainty as it pertains to trade and all of that. I'd argue it's not one versus the other here as well. I'd argue you probably want to have munis and treasuries and corporate bonds, but I'd argue again they're somewhat incomplete. One of the things that we haven't touched on yet, but I think it's probably somewhat self-evident, is most traditional investments are highly correlated with one another. And all we need to do is think about what happened in 2022, where the 60 and the 40 were both down double digits. So anytime there's a shock, whether it's a long shock like 22, or it's a short shock when we have things like the trade announcement, or we had COVID, even over short intervals, what we find is stocks and bonds are highly correlated in periods of stress. So I'd argue that there's a need to expand our fixed income or our income allocation to include private credit. Mike, you didn't ask the question, but I think in our previous discussion, we talked a little bit about private credit, and I'd argue that private credit is an area that I certainly get a lot of questions from advisors these days because people are concerned about the amount of money that's gone into private credit. And when I hear that, what I really think they're saying is a lot of money has gone into direct lending. Direct lending has been the ultimate beneficiary of a lot of advisors and investors saying, hey, I'm not getting anything from my fixed income. Where can I get alternative sources of income? Direct lending became the beneficiary of a lot of people seeking that alternative source of capital. I'd argue now, direct lending looks a little bit frothy. We're seeing spreads coming down. I'm not saying that all direct lending is bad, but I'm saying that it's definitely a little bit more stretched. We think areas like asset-based finance or real estate debt look really attractive here. Why? Because they haven't got all the money. And then also they're actually backed by something, right? So I actually have collateral behind it, which I think is a safer sort of way of lending capital. So we're particularly fond of real estate debt in this environment. We think real estate is obviously going through some challenging period of time. There's a wall of debt that everyone refers to that will need to be refinanced in the next several years. We don't believe that banks are going to step in and lend capital. They're very reluctant to do so. So I think private credit managers can step in and discreetly manage capital or lend capital where appropriate and dictate the terms, the conditions, and the covenants. So if we think of 2021, we had a lot of covenant-light investments. Now the private credit managers are actually dictating the terms and the conditions. So we think that's a more attractive area to be allocating capital if we're thinking about extending beyond traditional fixed income and looking at private credit. We'd like real estate debt probably our first choice.
Yeah.
Makes sense.
Makes sense. I mean, real estate's been going up a lot too, so that's seems like a better place to put your capital. One thing you brought up there is correlations. How do you guys kind of think about correlations when it comes to alternatives versus traditional markets? Are you seeing as much, like you mentioned, like 2022 equity and fixed income is very correlated? Are you guys kind of does alternatives kind of deviate from that a little bit?
Yeah, I think what we've seen over the last couple decades, we started this exercise, kind of post GFC, just looking at what the 10-year intervals have looked like. And again, anecdotally, we understand that correlations have been increasing, especially in periods of shock, but we actually see correlations have been increasing over time. And it kind of makes sense, right? With the free flow of information, everything is in the market. So at least when I was starting in the industry, we talked about the difference between large and small and value and growth. Value and growth are very highly correlated. Small and large are highly correlated. U.S. and international are highly correlated. And by highly correlated, they're 0.8 and above, right? They're moving in the same direction, although the amplitude could be different over time. So part of the appeal of alternatives is to provide that lower correlation. I mentioned real estate and real estate debt have negative correlation to both traditional stocks and bonds. Strategies like managed futures, we primarily talk about private markets, but if we switch gears and we kind of open our aperture a little bit and we look at hedge fund strategies, managed futures, of course, their appeal is having negative correlation and performing well in environments when you have a 22 where a shock to the system. 2008 and 22, you have these bad downdrafts, and you were happy if you had managed futures in your portfolio because they deliver positive returns. So again, depending on how we look at it, we can definitely reap the advantages of lower or negative correlation looking at some of these alternative strategies available in the marketplace.
Yeah, makes sense. As we move forward, Tony, I'm just curious from a market perspective, any other interesting opportunities you see or trends that someone should have in their toolbox going forward?
So I'll give you two trends that I think are really important, and then maybe I'll share kind of our forward-looking views where we see the best investment opportunities. So two trends that we're watching very carefully, and I'm sure you're seeing and hearing the same things that I am, is I think there's a real interest in getting private markets in retirement plans. I'm really excited about that. Again, thinking of my wife and my daughters who are teachers, if they have the ability to allocate capital to private markets, and they're not going to make those decisions, but to have at least a allocation of private equity and private credit in their retirement plans, that would be a huge home run for them. There's been a lot of work done by industry groups like DeCalta, and then some of the providers are starting to step up. I think almost every day over the last couple of weeks, you've seen a story about somebody introducing a strategy, whether it's somebody like an Empower or firms that are making strategic investments so they can offer them. I think that will be a really good thing for the industry if we can get there. I think it's going to happen slowly, though. I don't think that all of a sudden the spigots get open and the allocations in DC plans look like they do in DB plans, which is, of course, 30, 40%. But I think that's a really exciting development for the industry. The other is, as you and I have been having this discussion, it's probably apparent that this is fairly complicated. And I think that for many advisors, there is an interest in having models where somebody else is putting together public-private portfolios for you. So I think the development of models where you can actually farm out the decision of how much to allocate to strategies. I think those sort of strategies will get a lot of traction. They definitely fulfill a need in the marketplace. So I think those two trends are things that we're looking at. They're definitely happening now, but I think they'll likely accelerate in the coming years. And I think a lot of other industry groups are looking at them. So again, I don't think it's a fad that goes away tomorrow. I think they'll continue to grow, continue to be more viable. From an investment perspective, and I teased a little bit about some of this earlier, so we come out with our investment outlook in the beginning of the year. It's a private market outlook, so we just focus on the private markets. We came out with a 2025 outlook. We had a slightly different view of the market than the way that the overall market played out, but we had a very consistent view of where we saw the best opportunities. So again, I mentioned it earlier, probably our highest conviction idea is secondaries. So if we think about what's been happening in the private equity ecosystem, a lot of money has gone into the private equity markets. It's been difficult to put that capital to work. Because there have been little to no exits, it means that a lot of institutions found themselves over-allocated to private equity. So hence, they needed to seek liquidity in the marketplace. And the examples of that are Harvard and Yale, two very well-publicized sort of examples of they were seeking liquidity, lightening their exposure. Well, they can't go to the public markets like you can with your traditional investment. So they actively seek out secondary players in the marketplace who can help them execute those transactions. In fact, since 2021, kind of peak valuations, a lot of institutions have put in place formal secondary programs. So to me, I think that's a growing and vital part of the overall PE ecosystem. It has gone from a niche industry to a very big part of it. We think that continues to be. Of course, the benefit for the institutions is providing that liquidity. The benefit for you and me and your clients is they actually get the benefit of getting those great investments, some of which are seasoned, which means the J curve is shortened, which means I'm getting a distribution a little bit sooner in my portfolio. I'm getting diversification across vintage, the year that the fund was invested, across GP, who's the underlying investor, across geography and industry. So to me, it's a win-win-win situation for individual investors. And it's the closest you're going to get to having allocations similar to the way that big institutions do. They don't make a single private equity investments. They make 10, and they commit to the next deal, the next deal, and the next deal. So we think secondaries represent a really good way of getting exposure to the private equity markets. We like that. We think that's a story for the next decade. I talked about real estate debt. We like real estate debt for the obvious reasons that there's a lot of disruption in the real estate marketplace. It might surprise you. The flip side of that, we actually like real estate owning the underlying companies. We don't like offices. We think office will have a long-term secular challenge in just, everyone's resizing what the footprint looks like. And I think that's going to be a challenge for the next decade or so. But we do like real estate because we think valuations have come down pretty substantially. And a lot of real estate is now available below replacement cost. We like areas like industrials and multifamily. So if you can, it's much more of a sector allocation discussion, right? I want to allocate capital to those areas that look attractive and avoid those that look expensive. I'll give you just one example on that. So if we think about what happened with all this trade rhetoric and all the stuff that's going on, if we believe, and I'm not saying one way or the other we should or we shouldn't, but if we believe that part of that rhetoric is to bring more manufacturing to America, that means we need to build more factories, means we need more warehousing, we need more industrial parks and all of that. So there's a natural sort of build that will have to happen if we are in the process of reshoring. And by the way, the industrial sector has been the beneficiary of a lot of growth going on anyways. Think of Amazon fulfillment centers. So if we're really selective in how and where we think about allocating capital, industrials, multifamily, life sciences really look attractive. Offices, we leave them to the side. Which leads me to two macro themes, and this would be my last point, and I promise I'll stop talking.
This is good. Keep going.
So if we think there are two macro themes that all investors should be mindful of in looking at the marketplace, and that is, I think we're going to start to see a bigger dispersion of return between the winners and the losers in the private markets. And part of that is driven by an experience that we've all experienced in the traditional space, which is there are managers who often are tempted to take every asset coming in the door. And there's often a temptation of going to a space where you don't necessarily have the expertise, but you see a lot of money being raised in the space. So I think that seasoned managers who have deep and dedicated teams who have been managing capital for decades and decades will likely flourish in an environment like this. And those who are maybe newer to the dance and were greedy to take capital when they should have been saying no or slow down will likely pay the price. So we'll likely see a larger dispersion of return between the winners and the losers over the next couple of years. And our last macro theme, which I think is really very intuitive when we think about it, is we think there would be a big difference in allocating capital today. So if you have dry powder today, it's a great time to be allocating capital, right? All the damage has been done since peak valuations of 21. Prices are down substantially, whether it's PE, real estate, anywhere we look, valuations are down. I made the comment earlier for private credit managers who can now dictate better terms than you did at 21. So if I'm sitting in your seat and I'm looking at funds and allocations, I actually like allocating capital today versus allocating to something that was actually invested in 21, 22, where you probably paid very high prices and terms were dictated to you. So rather being a term taker, now you can be a term maker. So I think the last two macro points I think are somewhat self-evident and cut across everything that we talk about. But we think it's a great time to be thinking about allocating capital, having discussions with your clients.
Yeah, that's great. I have to ask you, Tony, crypto. What are you guys talking about to clients about right now? How are you guys thinking about it? Is there an allocation? Is there a place for it in your portfolio?
You had to ask the question. I will tell you, everyone from our CEO all the way down, Jenny Johnson, is a big fan of crypto. We have a team of people who have really done a terrific job, looking at the whole landscape, developing products around that. If you have any interest, I would definitely direct them to them. That is outside of my area of focus. I'm really just focused primarily on private markets with kind of a broader lens looking at hedge fund type strategies. But I would say that, the firm is very focused on crypto. We produced an awful lot of content and developed products around that. So I think it's definitely here to stay. And the question is, again, how to use it in client portfolios.
Yeah, definitely.
Yeah.
If I could ask you just a follow-up question, a high level on this. I know that's not your focus, but just given we see like tokenization and blockchain affecting access to private markets, what are your thoughts on that? Because that's more of a technology. It really kind of goes into the secondaries, which you mentioned, which is very interesting, right? Where you can kind of facilitate. The secondary has traditionally been more of a manual process for many folks. I'm just curious if you had any thoughts on that.
Yeah, and again, it's not my area of expertise. We definitely have people in the organization who are much more expert than I am, but I think blockchain is very exciting. Like blockchain is potentially transformational because it can dramatically improve the efficiencies and everything that we do. So I think you're going to hear a lot more about blockchain really kind of revolutionizing. I think tokenization naturally falls out of that. And I know in the alternative universe broadly, and then in private markets specifically, there's been a lot of discussions about tokenization. Could you buy smaller increments and all of that? So I think it's an exciting sort of development. So I would say that if you're interested, we have a think tank that's really focused on a lot of these things going on. We have this incredible resource, an individual named Sandy Call, and she has a whole team of people that are constantly imagining what the world will look like. And they do a lot of work on digital and tokenization and blockchain, which again will be transformational. They're looking at, how things look from your seat, how, you're going to be doing business in the future, how investments are going to be packaged in the future. All I would say is it's an incredibly exciting time because it's constantly changing. You're getting better tools than you've ever had before. You're getting access to better investments than we've ever had. And the more that we can simplify it, make it easier for you to allocate across your clients, I think that's a win-win all around. So a very exciting time for our industry overall. And I suspect if we have this discussion 5 years from now, it looked dramatically different than it does today. And that rate of change is remarkable considering how slow our industry was in evolving 20 years ago, right? The rate of change is just, exponential.
Totally agree. I think just even to date myself a little bit back in the late 90s, early 2000s, just back office operations and how to deploy different things. And it's still pretty spreadsheet heavy in 2025, I would say. And but how much change has happened in the last 5 years is pretty incredible in general.
I remember the 90s well. I remember, one of the things that we didn't talk about was, the challenging opening a lot of these accounts, right? And the paperwork. And interval and tender offer funds obviously are much easier than kind of first generation drawdown funds. But I remember being at Morgan Stanley in the early 2000s, and it was all manual. And we literally had one person whose responsibility was reading the offering memorandums to make sure that we can invest on our client's behalf. And a lot of the input was manual in nature. So as an industry, we've definitely come a long ways. I think sometimes we need to remind people of that journey we've been on. So yes, interval and tender offer funds are a little bit more complicated than a mutual fund, but it's a quantum leap from where we were a decade or two ago. The quantum leap forward is exciting because I suspect it will be pushing a button and everything happens organically.
Yeah, well said.
Yeah,
totally agree.
Tony, you have a book coming out soon. Tell us about this.
It's out. So private markets. It's a byproduct of all the traveling that I've been doing over the last couple of years. So I think I was on a 10-week travel, 10 or 11 cities in 10 weeks and getting a lot of questions over and over again. And I always felt like I'd walk off stage after spending an hour and feeling like there's so much more to say. So I think I woke up, this is my second book. So I woke up, called my agent and said, I think I want to write a second book. Met with my publisher 2 weeks later. I think I delivered a manuscript in record time, something like two months. To write a 300-page book.
Wow.
That's impressive.
But that also meant, writing around the clock. I feel sorry for my wife. It means getting up at 1 o'clock in the morning writing. But I was just so excited I felt like I really needed a book like this. And one of the things that was interesting is, there's so much exciting stuff, as we've talked about on the podcast, going on in the space, but I didn't find a book that it was actually written for advisors and investors. There were a lot of books in there saying how great some of the masters of the universe were in the private equity ecosystem. There were a lot of books saying, it's scary and dangerous, don't go near private equity. But there wasn't a book out there that actually spoke to how advisors should be using these with clients. So I wrote my book. I was pretty excited about delivering it and launched the book February 11th of this year. I made my first bestseller list in February, which was kind of exciting. The demand has just been incredible, and I've been overwhelmed by the positive feedback from advisors who said, this is great. By the way, this is something I would love to share with my clients because you actually reinforce a lot of the things that I've been saying to them for the last couple of years. So it's really written in such a way that I hope it works for advisors wherever they are in their journey, and hopefully it works for investors who are trying to figure out what is it that we're talking about. So I use a lot of these individual case studies that I talked about. I paint the picture of where we've been, highlighting how institutions and family offices have used these tools for decades and decades, paint a picture of where we are today. And then my last 3 chapters, I actually spent a little bit of time imagining what the future will look like. What does the wealth channel look like? What do the underlying investments look like? And then ultimately, what does this mean as private markets come to Main Street? What does it mean for the individual investor? And I'd argue it's a very, very rosy picture down the road. So it was a labor of love to write it. I've been thrilled with the reception so far. And I hope it furthers this discussion that we're all starting here together.
Amazing. Well, congrats again.
Yeah.
That's a big accomplishment. Book number 2
Thank you.
in record time.
Thank you.
Yeah. Awesome. Well, Tony, this has been a lot of fun. Really enjoyed this conversation. Where could people go to connect with you and learn more about your work?
Yeah, absolutely. I'm pretty visible on LinkedIn. That's always a good place to find me. You can go to Franklin Templeton. We have a knowledge hub, which is all free, objective information, which includes white papers, blogs, and my podcast series. And of course, if you're interested, you could get my podcast, Apple, Spotify, or wherever you get your podcasts. It's Alternative Allocations with Tony Davidow. Not very original, but it's great conversations like this, just talking to other industry folks about what's going on in the space. No products. It's just really designed to help people have better informed decisions about allocating capital.
Awesome. Well, this has been great, Tony. Like Mike said, we appreciate your time, and we'll make sure to include all your contact info, your book, and your podcast in the show notes as well.